In 1999, a 28-year-old entrepreneur named Elon Musk launched X.com with a radical idea for its time: a fully digital, borderless financial system that removed paper, delays, and middlemen from banking. At the time, the internet was not ready. Infrastructure was limited, regulation was unclear, and public trust in digital money simply did not exist. The idea was not wrong. It was early. XCOM eventually evolved into PayPal, proving that digital payments could scale globally. What was left unfinished was the original ambition: a complete financial system embedded directly into everyday digital life. In 2026, that ambition returns through X Money, not as a startup experiment, but as a financial layer built inside a global communication platform already used by hundreds of millions of people. On the first day of 2026, payments, identity, communication, and commerce begin converging inside what is increasingly described as an everything app. X Payments represents a direct challenge to legacy banking models that rely on friction, delays, fees, and centralized control. This is not a new bank. It is a new architecture. As of early 2026, X Payments reportedly holds money transmitter licenses in over 40 U.S. states. Historically, once compliance frameworks are established, remaining approvals tend to follow. Based on previous fintech rollouts, full nationwide coverage could realistically occur within 6 to 18 months, or faster if federal harmonization accelerates approvals. Unlike small startups, X enters this space with scale, legal depth, and existing financial partnerships. A strategic partnership with Visa provides instant access to existing merchant infrastructure. This allows users to spend digital balances at millions of locations worldwide without convincing merchants to adopt anything new. Adoption friction collapses because the network already exists. This is how financial systems actually scale. For analytical purposes, consider a scenario where X Money uses XRP as its settlement layer. In this model, XRP functions as a neutral bridge asset, eliminating pre-funded accounts and enabling real-time settlement 24 hours a day. If even a small portion of X's global user base adopts such a system, transaction volume would surge, liquidity demand would increase, and network effects could outpace traditional banking rails far faster than most expect. This kind of adoption would not unfold gradually. Platform-embedded finance spreads by default. When payments are native to communication, usage becomes automatic rather than optional. Money begins to move at the speed of information. The advantages are practical, not theoretical. Fees shrink as intermediaries disappear. Borders lose relevance. Access expands to anyone with a smartphone. For billions of people who are underbanked or overcharged by legacy institutions, this is not disruption. It is replacement. Now consider a high-stress global event where traditional internet infrastructure experiences failure or restriction. Legacy banks depend on centralized networks, physical branches, and office systems. When those systems go dark, ATMs stop working, card networks fail, and fiat liquidity freezes. If satellite-based connectivity such as Starlink remains operational, a phone connected to X Money could continue functioning independently. Digital wallets remain accessible, value can still be sent and received globally, and national banking outages become irrelevant. In this scenario, banks do not fail slowly. They are bypassed instantly. With blockchain-based settlement and digital identity, the phone itself becomes the bank. It becomes the account, the wallet, and the payment terminal. A digital debit card with a dynamic QR code enables everything from small daily purchases to large transactions without escrow delays or institutional permission. From buying an ice cream to purchasing an island, value transfer becomes direct, programmable, and permissionless. The system does not ask who you are banking with. It only verifies cryptographic ownership. Historical financial assets such as bonds can also be transformed. When bonds are tokenized into digital certificates recorded on a blockchain, each asset carries its own verified identity. Payouts occur on-chain, settlement bypasses fiat systems entirely, and transparency replaces trust. Once assets are born digital, there is no technical need to return to legacy currency rails. X Payments is not simply competing with banks. It exposes the inefficiencies banks rely on to survive. When money becomes software, speed beats size. Networks beat institutions, and trust migrates from intermediaries to code. If X Money successfully integrates global payments, digital identity, and blockchain settlement, legacy banking does not slowly adapt. It collapses under its own weight. The future imagined in 1999 did not arrive early. It arrived precisely on time. And this time, the world is ready. Good luck waiting for bond money to be paid through a failing fiat system designed to preserve control rather than deliver value. If this breakdown helped you understand what is really happening beneath the headlines, make sure to like this video, subscribe to the channel, and share your thoughts in the comments below. Join our Telegram group via the link in the comments for daily updates and research-based discussions. We inform, you choose.